Well, good afternoon, ladies and gentlemen. Good morning or good evening, depending where you are today. And it's my pleasure to welcome you to this Scope Ratings webinar on the Retiro Mortgage Securities Spanish NPL ABS. My name is Keith Mullin, and it's my pleasure to be taking you through this session today. You may have seen that Scope assigned the ratings to this transaction on the 31st of March. But we thought it would be actually instructive and helpful to the market if we actually we went through a series of comments and slides which define our ratings drivers and our approach to the transaction. I'm delighted to be joined today by Chirag, Shekhar and Paula Lichtensztein from Scope's Structured Finance team. In a couple of seconds, I'm going to pass the floor over to Paula and Chirag, who will take you through a very short presentation. Now, the intention here is for this to be as interactive as possible. So you do have a chat facility available on the web platform. So please feel free to ask questions throughout the session. Once the formal presentation has ended, we'll pass over to a Q&A, and we'll take the questions that you may have posed during the session at the end of the presentation. So that's it from me. It's my pleasure now to kick off the presentation. And Chirag, I believe you're going to kick us off. So the floor is yours.
Thanks, Keith. Thanks, everyone, for joining us for this webinar today. My name is Chirag Shekhar. I'm an analyst with the Structured Finance team at Scope, and the lead analyst for the transaction we'll be discussing today. Retiro is the first public Spanish NPL securitization since Prosul in 2019, which was also rated by Scope. The transaction is not a true sale of receivables to the issuer. Instead, the issuer is the sole senior secured creditor to a two-tiered management system, management structure with a mortgage lender, which is an SPV with credit rights over the loans, and propcos, which feature typically in Spanish NPL securitizations, which have rights over the real estate-owned assets. This vertical management system is replicated for each of the four sub-portfolios that have been securitized, which in total comprise of REO assets that amount to 396 million, roughly, in terms of total appraised value, and NPLs with a total current balance of around 678 million. For more details regarding the management structure itself, we would request that you please refer to a rating report. We won't go into too many details here, but the assets are backing 8 tranches of sequentially amortizing notes, of which Scope has rated 4 tranches, which is, as you see, with a total notional of around 386 million euros. We have rated the Class A1 notes BBB+, A2 notes BBB-, Class B notes single B-, and Class C notes at CCC. A notable feature of the notes is that each tranche features a so-called additional note payment. These are deferred payments due to the note holders of all tranches of the rated notes, and accrue from the first additional note payment date onwards, which is in April 2026. The rate of this additional note payment is 2% for Class A1 and A2 notes, 3% for Class B, and 4% for Class C notes. These additional note payments are junior to principal repayments towards the corresponding tranche of notes, so they're fully junior to the principal of each respective tranche, and they do also earn penalty interest. What's important to note here is that the additional note payments are not considered as interest on the notes, as is, our ratings do not address the timely payment of this component. However, as I just described, due to the priority they take in the priority of payments, this does have an impact on the mezzanine and junior notes, which we will get to as we discuss the rating drivers. I will now hand over to Paula to guide you through an overview of the portfolio and some key aspects of our methodology.
Thank you, Chirag. Okay, let's take a look at the main features of the portfolio. Most NPLs are senior secured, around 94.5% of NPL current balance. Mortgage loan collateral and REOs are mostly residential properties, almost 78% of index property value. This is credit positive as residential assets are generally more liquid than other type of assets. There is some geographical concentration in Catalonia and Valencia where recent legal developments have not been particularly creditor friendly. Both regions account for around 53% of index property value. The majority of borrowers are corporates or SMEs, around 67% of total NPL current balance. The NPL portfolio is highly seasoned with a WALT of around 11 years since default. And there's a significant share of loans with high LTV, specifically almost 60% of the NPL balance are loans with an LTV above 200%. This is credit negative as the sale of the property collateralizing the loan is unlikely to fully cover the outstanding debt unless properties are sold well above appraisal values. In this slide, we provide a short overview of our methodology to rate NPL transactions. Recovery amount and timing assumptions are the key drivers for the portfolio cash flow projection. We apply a bottom-up analytical approach that allows us to consider transaction-specific factors such as the quality and type of collateral, the accuracy of property appraisals, exposures to specific regions, and the servicer capabilities. For secured NPLs and REOs, we estimate the value of the property at closing by considering the quality of the appraisals and then applying rating conditional security value haircuts to capture forward-looking market value and liquidity risk. So our starting point is generally a third-party property appraisal, which, depending on the valuation date, we may adjust considering some indexation and/or depreciation adjustments. We also apply rating conditional valuation type haircuts that capture the quality of the appraisal. We then apply forward-looking rating conditional property price change haircuts, also referred in our methodology as market value decline assumptions, which are calibrated considering the property location. We also apply rating conditional fire sale discounts, which may vary depending on the type of property, and we capture liquidity risk. We may apply adjustments to factor in other transaction-specific features, such as borrower concentration. The analysis is conducted on a line-by-line basis and then aggregated at portfolio level. Our assessment of the serviceability complements the portfolio analysis. Our recovery timing expectations are typically specific to the transaction based, among other factors, on the stage of proceedings at closing, the asset repossession status in case of REOs, the servicer experience, and any eventual applicability of specific recovery strategies. We also assess transaction legal risk, operational risk, and financial risk from transaction counterparties. And the cash flow analysis always considers the specific structural features of the transaction. Going into the specific case of the transaction under analysis for Retiro Mortgage Securities, the primary source of recoveries are expected to be proceeds from the sale of NPL collateral and REO assets. We apply rating conditional haircuts to property appraisals to capture the quality and date of appraisals, as well as market value and liquidity risk. The weighted average total haircut was 39.4 for Class A1 analysis. As regards the timing of collection, for NPLs, we assume a total time to liquidation equal to 78 months under Class A1 analysis. This considers an estimate of both the length of the legal proceedings based on the type and stage of legal proceedings at closing, and the expected time to sell the assets collateralizing the loan after repossession. For REOs, we assume a total time to liquidation equal to 28 months for Class A1 analysis. A time to sell assumptions consider both the property type and the local real estate market dynamics. We also assess the asset carry cost, such as the property taxes and asset management fees. These costs could be material in case the time to liquidation is longer than average, for instance, in the context of an illiquid real estate market or due to unfavorable legal developments. I now pass back the word to Chirag, that will discuss the positive and the negative rating drivers in the context of our analysis for Retiro.
Thanks, Paula. So moving on to the positive rating drivers, clearly the first one is the composition of the portfolio itself. As Paula mentioned, the portfolio is composed mostly of senior secured loans, which clearly that gives the servicer the opportunity to enforce the security, which we view as favorable as compared to portfolios with a large share of unsecured or junior secured loans. But then the properties themselves are, in terms of the asset type mix, are favorable compared to other portfolios, which is to say that a significant share of assets are residential at about 78% of total appraised value. Furthermore, as discussed earlier, the portfolios have been under management for a while, at least in the case of the 4 sub-portfolios for 1 year at the time of closing. This means that we do not expect any teething issues or ramp-up issues in onboarding of the portfolios. These processes have already been completed. Moving on to the structure, we've got strong liquidity support for all rated tranches of notes. The Class A reserve covers A1 and A2 interest and senior expenses for more than 5 payment periods. For Class B and C, the reserves cover up to 10 payment periods. So liquidity support is significantly stronger compared to some other transactions that we've looked at in Spain. Then on the interest rate hedge, we don't not only have an interest rate swap that the issuer enters into or has entered at closing, which provides protection against increase in the base rate, but there's also a structural cap on the base rate, payable base rate on the notes, as this is basically capped throughout the life of the transaction, first through the swap and then through the structural feature in the terms of the notes. Finally, another positive feature of the assets that we note is that most of the assets, in fact around 87%, are located what we term as average or areas with average or above average liquidity. To summarize how we've come up with this approach, I'll move on to the next slide, where you can then see on the left Scope's liquidity score model. This is a quantitative model which uses socioeconomic data at a very granular level for Spain, which is available from public domains and goes down to the central district level, which we then concentrate at the level of each postal code in Spain. We combine this with alternative data sources, mainly data from public real estate listing websites in Spain, to come up with a liquidity scoring mechanism so as to be able to better distinguish between portfolios in jurisdictions where REO assets form a major segment of the portfolio. On the right, you can then see how this links to the distribution of the portfolio itself. As you can see, we've got major concentrations on the eastern and southern eastern coasts of Spain, and also a major concentration in Madrid. Most of these assets are then located, as you can see, in major urban and suburban population centers, which generally offer more liquid asset markets. Moving on to some of the negative rating drivers. First of all, we've got a significant share of assets that had been valued generally at the time of acquisition of the respective portfolios, which makes roughly 43% of the assets being valued prior to 2018. We believe that the valuation of these assets may not accurately represent the state or the current state of the assets, and therefore we do apply an adjustment to account for any potential depreciation in the condition of the asset. Secondly, we've got a significant borrower concentration risk in that top 10 borrowers represent roughly 16.4% of the current balance in the non-performing loan portfolio. What we view this as a risk essentially because of potential resolution mechanisms that the servicer may either be forced into or potentially may accept some time value benefits instead of going for fully maximized recoveries due to the complexity of the position, etc. And we do apply a haircut to these top positions to account for that potential risk. Moving on to the structure, as I mentioned before, each tranche of rated notes features an additional note payment. And this means that the mezzanine and the junior notes, so Class B and Class C notes, are exposed to higher duration risk as all tranches earn additional note payments, and these tranches remain fully subordinated to both the additional note payment that has been earned on the senior notes, but also the penalty interest that these payments incur through the period in which the Class B and Class C principal is finally paid out. Then we also have a major concentration in Catalonia and Valencia, as Paula pointed out. Recent legislative developments in these autonomous communities have not favored creditors. Instead, they have favored occupants, and especially those at the risk of residential exclusion. We do note that the Supreme Court in Spain has partially annulled the Catalonian law that favored long-term occupancy of assets by those at risk of residential exclusion. But we do believe that some such risks, including in Catalonia, but also in other autonomous communities, remain material, and we factor them in our legal timing assumptions. Then finally, in terms of the representations and warranties that we have in this transaction, we note that these are not as strong as the representations and warranties we have seen in other European markets, notably the Italian market. However, again, here we do note that the servicer has provided us some clarifications regarding some of the missing representations of warranties or reps and warranties where there were exclusions made, and clarify the reasons why this is the case. So for an instance, we note that the warranty, there is no warranty as to there being no payable tax on the Rio assets. However, the servicer clarified to us that the tax liabilities on such assets may take a while to be clarified, and this is part of their normal course of business. And one additional factor to highlight is that there is no backup servicer appointed at closing, and there's no backup servicer facilitator either. However, again, I would note here that the master services have undertaken to assist in the appointment of a replacement servicer should there be a servicer disruption event. And secondly, they have also undertaken to step in should there be no replacement servicer appointed within 180 days of such an event. So with that, I think we have covered everything we wanted to present today. I hope it was helpful. I believe we're now going to be taking some questions, Keith.
Yes, indeed. Thank you very much indeed to Chirag and Paula. We actually do have some questions that have come in. Some are general, some are quite specific. So let me just go to them very quickly, if I may. And one question coming is as follows. According to your criteria, would it be possible to achieve an A rating on the most senior tranche of Spanish NPLs? How would the stress change versus a triple B? Paula,
I can take that one, Keith.
Okay.
Yes, I can take that one. Yes. Yes, it is possible to achieve an A rating. Actually, we have rated very few, but for instance, one Italian transaction, the most senior tranche is rated in the A level. As we were saying before when we were describing the methodology, we apply both MVDs and partial discounts rating conditional. So we would certainly increase these two haircuts. Clearly, let's say the haircuts are transaction specific, so there's no preset level of increase that we can share today with you. But this is certainly possible. Also, for this transaction, particularly, there's plenty of liquidity. But when we analyze a transaction and analyze if it's possible to go up to the A level rating, we also pay attention on liquidity, both on regarding structural features such as the fact that NPLs do not generate regular cash flows. So by nature, liquidity is important. But also in case of the event of the servicer replacement, that may also jeopardize the cash flow coming into the structure.
Very good. Thank you very much for that. And we have a question on rep and warranties, which perhaps I could put to you both, which is basically, what do you mean by relatively weak rep and warranties in terms of maximum indemnifiable amount or in terms of coverage? Chirag, do you want to take that one, perhaps?
Sure. So not necessarily in terms of the maximal amounts or in terms of the coverage itself, rather the reps and warranties that have been included by themselves. We know that there are certain warranties that are missing and certain other warranties that are made with specific exclusions. So as I was mentioning before, for an instance, one of the exclusions is that we do not have a warranty as to there being no tax dues on the real estate-owned assets. We do understand that this is part of normal course of business in Spain. However, regardless, compared to other standard securitizations in other European markets, this is certainly weaker in that sense.
Okay, thank you. I've got
maybe, Keith,
yeah.
Sorry, maybe one thing to add on that is that, as Chirag was just saying, this is, let's say, weaker than for instance, specifically in Italy, where there have been a lot of transactions and where rep and warranties are generally stronger. Clearly, there are some variations among transactions, but as a whole, we can say that the Italian transactions entail much stronger representation and warranties compared to what we have seen so far in Spain.
Okay, yeah, thank you for that. Perhaps I've got another question, which is, I guess we couldn't have a session on anything today without mentioning COVID-19. But Chirag, can I put this on to you? How have you addressed the potential impact from the COVID-19 pandemic in the analysis of this transaction?
Sure. So, well, Spain has been one of the worst hit European countries during the pandemic, and we do factor this in two ways. So in our methodology, as Paula highlighted, there are two main aspects of NPL cash flows. One is timing, another is the total recovery amounts. And so we factor potential macroeconomic risk of house price declines in the market value decline assumptions, as Paula was mentioning. But we also factor in potential delays in legal procedures on non-performing positions due to backlogs in courts, or perhaps teething issues due to transition from a mostly offline process to a mostly online process, and so on.
Okay, thanks. Let me just, there's another one that's just come in. Let me go to it quickly, if I may, which is this. You refer to you refer to liquidity support of 5 and 10 period payments for Class A1 and B/C respectively. Does that imply Class A2 has similar coverage to A1?
Yes, the liquidity reserve is both. There are, let's say, specific liquidity reserve for each tranche, and A1 and 2 are considered just one, and then there's the dedicated liquidity reserve for Class B and C, and they are all funded at closing, and they are funded such as to cover enough liquidity needs throughout the life of the transaction for all these tranches.
Okay, thanks. And then let me go back to you, Chirag. There's one I think perhaps you could answer here, which is, could you please highlight any potential drivers of an upward or downward future change in the ratings?
Sure. Well, so first of all, on the servicer performance, if we see continued servicer outperformance, either in terms of the timing of collections or in terms of the amount of collections, that could certainly result in an upward change in the rating. At the same time, if assets take longer to liquidate than is currently expected in the business plan, or indeed in our analysis of the notes, that could lead to a downward change in the ratings, essentially and mainly because we do think that this could lead to higher than expected asset carry costs. So that would have to be taken into account in such a scenario. Needless to say that there's still a lot of macroeconomic risk that is, we have to factor in potential uncertainty around a lot of factors. So it depends on how they materialize, and that could also lead to a downward change in the rating.
Makes sense, indeed. Paula, there's I guess a more general question about Spanish NPL portfolios, which I perhaps could put to you, which is this. What are some unique features of a Spanish NPL portfolio as opposed to those in other jurisdictions like Italy?
Well, first, there's a difference in the process of enforcing the security. In Italy, assets are typically sold in a judicial auction. And if the first auction is empty, then the judge sets up a second auction where the starting price can be up to 25% lower than in the previous auction. And there could be other auctions with progressively lower starting prices if the previous auctions are empty. In Spain, there's also an auction process, but if the first auction is empty, then the mortgage guarantee is released. This is why real estate assets are typically repossessed by the creditor at the first auction and then sold in the open market. And this is why banks, after the great financial crisis, have acquired lots of real estate assets. As a result, we see propcos as a prominent feature of all management structures. Some services sell assets as is, whereas others allocate funds to capex with the aim of increasing property value and selling it at higher profits. Another difference between Spain and Italy is that the housing market in Spain has historically been more volatile than in Italy. And we address this factor in our property value decline stresses, factoring in higher stresses at higher rating levels compared to Italy.
Yes, interesting indeed. There are some questions, quite specific questions coming in, and so rather than read them out, let me and either put Paula and Chirag on the spot, could I perhaps alert you to some of the remaining questions, which strike me as being quite specific. So can you take a look and let us know if you can answer, or if not, then we can always circle back to the questioner. But let me know. Okay, there is a question. Okay, Chirag, there's one here which I think you're comfortable with, which is continuous surveillance and dynamic new models are required for NPL securitization. How does the scope rating approach to this, and how often are reviews made?
Right. So we have an internal surveillance system for NPLs where we essentially follow the frequency of updates or reporting on these securitizations to ensure that we have ongoing surveillance of all of our ratings, which means that we observe both the liability and the asset side evolution over time. This gives us quite a broad market-wide perspective on these securitizations, including peer group analysis, which we then use to review our ratings. Generally, we monitor ratings as soon as there is a market-wide event, or more generally speaking, on an annual basis.
Very good, thank you. And let me just keep checking here. There's a question which, again, I'll put to you, if that's okay, which is, are the debtor-friendly laws, I think, which you referred to, Chirag, just a timing delay issue, or are you also assuming a portion of loans in certain regions will be written off?
So on this issue, the law that we were most concerned with, also given the concentration in the portfolio, was the one in Catalonia. Part of that law has been annulled. However, generally speaking, we've seen similar developments in Balearic Islands and Valencia and some of the other autonomous communities as well. We see this mostly as a timing issue at the moment. However, the potential timing delay should an asset actually be occupied by borrowers or occupants who fall within the remit of the law, could really lead to very material delays. So we do think that this would be more of a time value effect rather than a direct, let's say, haircut to the potential recoveries in a position.
Right, very good. I think that is it for now. There are, I know, a couple of things that we'd prefer to take offline, if that's all right with you. So unless Paula and Chirag, you have anything more to add that you may have omitted to say before, or unless indeed any of you dialing in have any quick specific questions, we'll give it maybe another few seconds. We will close the session.
No, just keep that clearly as usual. We are available to discuss one-on-one any specific questions market participants may have on this specific transaction or on NPL markets as a general.
Very good. Well, in that case, let me once again thank Chirag and Paula for their comments during the presentation and taking the questions. Thank you for dialing in to listen to the session today. Hope you found that helpful. We will circle back to you after the event, and please feel free to reach out to us, as Paula said. We are doing more and more of these short webinar sessions on both on thematic issues as well as on specific ratings and rating drivers, particularly where we see elements of innovation or novelty. So we'll keep you informed on those. So that's it from us. Thank you again for dialing in. Thanks for your attention. Stay safe, and we will see you next time. Goodbye for now.
Thank you.
Thank you. Goodbye.